Today's episode, we are going to talk about our usual market updates, and we're also going to get into talking about why your 3% interest rate might be costing you money. Now, maybe it's not a 3% interest rate, could be even a little bit lower, maybe a little bit higher. But that's what's really holding people up these days when we talk about low inventory from selling, is that low interest rate. So we're going to get into ways that maybe that is costing you a little bit of money that you don't even realize. My name is Ben Larson. I'm here with Engel and Volkers Realty, and thanks for joining me here today on this episode. So what we're going to do is get into what I mean by the 3% interest rate and how it might be costing you money. Well, right now mortgage rates are as high as they've been in a very long time. We all know that they're over 7%. What your rate is depends on a lot of different things, what you're putting down, your credit, income, all of that. But we know it's a lot higher than it was year and a half, year ago. Year ago, actually, probably not too much higher than that because it did go up by then. But year and a half, 2 years ago, we're well over where it was at that point. So what do I mean when I say that 3% interest rate is costing you money? Well, it was interesting because I didn't even think about this until someone had brought it up to me. It was our lender, Michelle Rogers, great lender. So if you have ever need anything, reach out to me and get your contact information. She's with Cross Country Mortgage. But it's a good concept because she's seen when she's looking at someone's full financial picture. But yeah, they have a great mortgage, but they also have a car loan, and they've got personal loans and credit card debt. And if you don't have those loans, you may not realize the interest rates are really, really high on those. So they might have a 3% mortgage, but they have $30,000 in a car loan that's at 15%, and 10 or 20,000 in credit card debt that's at 25%. Personal loans, 50,000 at 15 to 20, 25%. Those are huge numbers. And when you figure you have a home, you have a lot of equity, you can actually pay those loans off. And yeah, you might get a 7% interest rate, a 7.5% interest rate on your mortgage, but depending on where that mortgage is and the mortgage balance, when you actually figure that into and everything together, and you look at the big picture when you're reducing, I don't know, whatever those numbers are I just gave, could be 100,000 in debt at a 20 to 25% average interest rate. And you're taking on, you might have a mortgage of 500, 700,000, whatever that may be. When you get that new mortgage at 7, and there are ways of buying that down and making that not quite so high. So maybe you can get it down into a 6 or 6.5. But either way, if it's in that range, it does seem like it's way over where your current mortgage is. But when you roll all of that in, it may not reduce your I've seen calculations where it actually reduced or was a complete break even for someone on their new mortgage, and they didn't want to buy that new home that they really wanted. They really wanted a pool. I've got people that just really want a yard, and they're looking at this big number that their mortgage is going up to, but they don't realize what their overall monthly will be. So like I said, I've seen examples where the monthly is actually less. The monthly is break even. But what if the monthly is only a little bit higher? You look at what your mortgage payment may be going up to, and it could be going up considerably. It could be doubling or 1.5 times of what it is. It could be $1,000, $2,000, $3,000 more than what it is now. But if you're reducing your overall monthly debt payments by $1,000, $2,000, maybe you're only paying $500 more to have that house with a pool. You are moving up in price, you are moving up in rate. So maybe you only have, this could apply to a refinance as well. Maybe you're just pulling money out because you want to add a pool to your house, and it looks like you're adding a ton to it. But if you can refi some of that higher interest debt with a line of credit or a overall refi into a new first mortgage, even though the rate on that first mortgage is going to be higher than what you have now, and everybody's brags about their 3% or their 2.75 or 3.25. They don't want to go to a 7, 7.25. That's a big jump. But when you just look at the dollar amount, it actually may not be that big of a difference overall if you're looking at the big picture. So maybe it is, maybe you don't have a lot of that high interest debt, then great, good for you. A lot of Americans are taking on more and more of that debt these days, we're seeing. So if you are in that situation, reach out to me, reach out to your lender, reach out to me, and I can introduce you to our lender. And they can run those calculations and look at your overall picture and say, you know what, to move up to that house that you really want with that office so you can work from home, it's only going to cost you $500 more a month, $700 more a month. That may be worth it. Depends on your situation. So that's just my little tidbit here up front. But then I wanted to touch on what's going on with the market a little bit right now. How's the market? That popular question we always get. So what I'm going to do is share my screen here, just go through a few things with you. So these are some numbers we're looking at for the month of September. And first thing I'm going to look at is I have an area that I mapped out for the South Bay. That's this big blue line. I pulled up some other cities as well. You can ignore those for the time being. What I want to look at here is South Bay as a whole. And I'm going to make sure we're looking at single-family rental, single-family homes, condos, and townhomes. So we're looking at South Bay. And first thing I'm going to look at is active listings. These are the number of listings that were on the market, still available at the end of last month. There's big talk about how that's really low and it's down, and it is. But a trend that we were talking about in our meeting, we do a market update meetings every Monday. We're talking about, we're seeing this trend where the number of active listings is going up. It's bouncing around, leveling off a little bit here, but we've seen a pretty good bump. And you're going to see that in September, but you have to put it in relation as well. So yes, it's bumped up a little bit, but 679. Let's see where we were before the pandemic. All right, September of 2019, 1184. That is way more than 679. So we're down probably about 40% from where we were at that point. I didn't do the numbers real that quick. I don't have a calculator handy, but round numbers, it's just over 50%, right? So that is down considerably. And we say it all the time. You may not remember back to September of 2019, but it was pretty active at that point as well. So we did have multiple offers. It was competitive. So we're down well under where that number is now. So I wanted to touch on that a little bit. We'll look at new listings. New listings coming out. It's pretty level from last month. So we're not seeing new listings coming out, but we're seeing active listings going up. What does that mean? We have more listings on the market and not as many coming out. So then we must not have as many going into escrow. That's why there's more that are active. There aren't a bunch more coming out, but there are more sitting on the market. That means pending sales are down. So pending sales are down. And now what does that mean overall? We're still in a competitive market in certain situations. Not every home is selling quickly. It depends on the price point, on the area. That's why we say, it really depends on your situation. So reach out, ask, how does this apply to me? Where my house is, what price point my house is in. Those things really play into it. The condition it's in. Is it on a busy street? Is it not? Is it in a great area? Is it remodeled? Is it not? All those different things play into a lot of this. The number of homes, we're still seeing multiple offers. I still have buyers that are looking for homes that can't find them. And they are ready to go. So the buyer demand is still there, even though it is a lot lower than it was during the couple of years after the pandemic. So those are a couple of the things, three stats I wanted to look at real quick. I'm going to touch on those in your areas as well. So go here. All of these. So we've got looking at these compared. So you can look, we'll start with Manhattan Beach. And I'm going to just get rid of these others. We're going to look at it. Pending sales down. We expected that. Active listings also ticking up. New listings bouncing around a little bit, but down for September. So you can kind of see where that is. Active listings, this is just a number I like to look at. You can see how low it is compared to where we were before the pandemic. So September 2019, 170, we're at 83. So that's below 50%. So let's go and see what Redondo Beach is like. We're going to see a very similar trend. Active listings, 104 active listings, 189 September 2019. So you can see all these, it's going to be a very consistent trend. Pendings down, new listings down some, not as steep of a drop as pendings. So I'm going to look here. What I like to do is pull up our Palos Verdes Realtor Association. So what we'll do then is we'll do so looking at, we're going to get rid of Redondo Beach. We're going to look at just the PV area. So you can see new listings have been bumping up and down, and then down and ticked up a little bit in September. Active listings also bumped up. Pendings, guess what? Yep, it's down. So pretty much what I figured there. So let's go and look at Torrance, which is as the last one. Those are some of the main areas that most of our clients are in and looking at. Pending sales, been bumping up and down. And then the last 2 months, it's just dropped quite a bit. Active listings actually is bumped up. So that, looking at new listings, it's been pretty consistent the last few months, bumping along, but pending sales are down. And that's just where it is. We've had a number of jumps. Interest rates keep going up. The Fed did not raise interest rates this past month, so that is a good thing. We're hearing two sides of what's going to happen at the next meeting. A lot of people think they're going to hold steady and not raise it. Few people think maybe they are. So we're going to have to see how that plays out. But that's the pendings being down has been a big part of where the rates have gotten these last couple of months. But with inventory still very low, if the home is priced correctly, it's in good condition, it is typically going to sell. I do a seller webinar where we go into a lot of this in depth. If you have any questions about that, feel free to reach out. But otherwise, thanks for joining again today. And if you like what you're hearing, definitely click the subscribe button, turn on notifications, keep following us here. And I'm going to keep putting out some of this information. So hopefully it keeps you updated on what's happening in the market, because you're going to see a lot of headlines, and those headlines just typically they're not accurate. They're just trying to get your attention. And when you read the article, it actually says the opposite of what the headline says. So from here, you're going to get the straight scoop. So anyway, thanks again for joining. This is Ben Larson with Engel and Volkers. Have a great day.